So moving on, our next panel discussion is AI Investor Circle, the good deal test from traction to institutional rounds. As ventures transitions from early traction to institutional rounds, we're going to explore what makes a high-growth startup truly investable, how funds collaborate to build confidence, and how shared insight drives stronger returns. So now I would like to invite our panel chair and panelists to come up on stage. So may I please invite Mr. Oscar Ramos, Managing General Partner, Orbit Venture, please come up on stage. And also our panelists, including Mr. Richard Yang, Managing Partner, Sinovation Ventures. And next, let's welcome Mr. Jake Chan, Managing Partner, Hony Ventures. And last but not least, Mr. Kenny Ho, Partner, NextGen Partners. Let's give these gentlemen a round of applause. Welcome. And now, without any further ado, I'm going to pass over the stage to you, Oscar.
Yeah, thank you very much. Well, first of all, great pleasure to be back in Hong Kong and to be able to join this forum. As Orbit, we've been working with Cyberport for over a decade in many initiatives. So being able to join this forum, meet here with co-investors, with many of our portfolio companies, a number of partners, is a great opportunity. And I'm very excited to have the chance to moderate this panel, because I think this is a question that many entrepreneurs have in their mind. But I think they formulate it in a slightly different way. No? They think about, why are VCs not finding startups, or why are they not investing in startups? And this is kind of the way we're going to be driving the conversation. So first, we'll talk a bit about like what is actually getting funded, why is it getting funded, and how can entrepreneurs improve the chances of investing by helping investors make decisions. No? So we have a bit more time, and originally I was going to be the one introducing all the panelists, because we have a bit more time than we originally thought. I think we can just go through a round of introductions. We talked a little bit about how to make the introduction, so please, Richard, if you don't mind, we can just go this way.
All right. Thank you all for being here, and also thank you, Oscar, for hosting us. So my name is Richard Yang. I'm from Sinovation Ventures. So we started 16 years ago by Dr. Kai-Fu Lee as an incubator, and now grow to a multi-stage venture and technology basically investor, mostly focusing on mainland China, but we also invest internationally. So our team right now is 30 people. We're now headquartered in Hong Kong. And our investment stage span from seed all the way to growth. And actually, thank you, Professor Ho from City University, for bringing us back to the good old days as an incubation player. We're deeply rooted in the southern China and Hong Kong. For example, we have a company called In Silico Medicine, also located in Cyberport. So we're very happy for this opportunity to exchange some idea how we support company from very small all the way to pre-IPO. Thank you.
Thank you very much. Jake, would you mind to be next?
Thanks, Oscar, and thank you, Cyberport, for inviting me. So I'm Jake. I head up Hony Ventures. Most people would know Hony as the private equity powerhouse in China. Hony Ventures is actually as the name suggests, the venture capital arm of Hony Capital. Different to Hony, which is the large sort of buyout PE player, where what we really want to do is be the first check investor out here in Asia, as well as across the globe for a lot of tech companies. Our main sort of three theses or three sectors is really AI, robotics, as well as healthcare. Those are our three main sort of focus sectors. At the moment, we run roughly around 500 mil under the ventures arm. And yeah, I mean, I'm very happy to be back here in Hong Kong, which is where I was born and where I'm originally from. But all these years away from Hong Kong, now I'm finally back and trying to play a role in growing the startup scene as well as the entrepreneurship here in Hong Kong.
Thank you, Jay. Kenny, if you don't mind.
Great, thanks. I'm Kenny. I'm from NextGen Partners, which manages a fund under Alibaba Entrepreneurs Fund, which we call AEF. AEF, as you may know, was established about 10 years ago to support the growth of the tech ecosystem here in Hong Kong with the capital contribution from Alibaba Group. So We're now on our third fund, a fund which is focusing on investments in AI applications, right? So we take advantage of the resources that we have from Alibaba Group, in AI, across the AI tech stack to help with our, deal sourcing, portfolio management work, and so on and so forth. In terms of stages, we typically look at companies that have demonstrated product market fit, which typically would happen, as you know, around Series A-ish funding rounds. And we also have a greater China focus, though we also invest internationally if we see the opportunities right.
Great. Well, from our side, I'm managing general partner of Orbit Ventures. We actually been in the region for a long time. We launched in 2010, which was the first accelerator ever launched in China, in Asia, and actually in an emerging market. We've invested in over 300 portfolio companies, and we have actually a good number of them that have either a Hong Kong base or that connected with Hong Kong. No? And funny enough, we have co-investments with Sinovation and also with the Alibaba Entrepreneurship Fund, not with Hony at the moment. We'll work on that. We'll work on that to make that change. But for us, our investment is in most cases earlier. We're investing in pre-seed to pre-A companies, and after we work on this model that had a small twist on accelerators that 15 years ago was relatively innovative, because most of the accelerators were focusing only on packaging the companies for fundraising and then present them in front of investors through demo days. But then when the investors look at the companies and they analyze them, they say, well, not that interesting. Okay? And what we did was, look, let's make sure that there's something investable here. And only after that, we work on preparing the companies for fundraising. That worked out really well, and that was something that have helped us and our companies raise significant capital. This is a model that, as the world changes, also have been changing. And right now, we spend a lot of time on that, like helping our companies not just fundraise, but scale. No? And that's kind of what I want to talk about. But the truth is that we're talking about AI everything. We're talking about AI. And many founders in the back, they were joking, well, whatever you do, just put AI or every investor is going to ignore you and is not going to talk about you. So I think the first question, let's go from something more general. No? What is getting funded right now? Like, as you guys talk with other investors, so what is now getting the attention of investors? And if you can refer us the latest company that you have invested and share why did you invest in that company? Or what did you saw in that company that made you make the move? I think we can change order right now, so we can start from that side. Kenny?
Sure.
We don't want you to be the last one always.
So the last panel, hopefully I'm not taking opportunities from the other panelists here. Thank you for the question. So perhaps I could illustrate this point by, as you suggested, talk a little bit about the latest investments that we have made. So our latest investment is in a company that basically optimizes hardware that are used for AI compute, right? So we don't invest in the hardware themselves, but we find that companies that develop solution to make the hardware run more efficiently, at higher performance levels, it's something that is quite interesting to us, because this is an area, particularly in China, that is levered to the, significant capex spend that, big, companies like Alibaba, Tencent, Baidu are spending money on in terms of building out the infrastructure to build the capacity for AI, right? So we find that there's a lot of opportunity in that area, and that's kind of something that we get very excited about.
Okay, so there's an AI hype, and you're also looking not just at the AI companies, but those that are making that growth in the industry.
Yep.
and taking advantage of efficiency. Okay, good.
Yep.
That's for example one good idea. Okay, Jake, anything on your side? Like, what are you seeing right now getting funded, and what are your last investment?
Well, the first thing is anything without an AI is definitely not catching a lot of eyes, I would say. So to the founders out there, of course, having that AI tag is important, but at the same time, don't overhype it, right? Obviously, everybody's slapping AI on anything and everything, and when you open the box as an investor, when you actually open up the BP, you realize it's just an automation or it's just a good old sort of fashion company. Then you get very disappointed, and we walk away, right? In terms of our last,
I want to emphasize that for founders, no? Like the overhyping actually has negative experiences. So you might feel, oh, I'm having progress because I'm getting more leads, but actually those leads are actually crossing you, and you might kill an opportunity. So sorry.
No, definitely. I think as a venture, we see way too many PBs every day, and obviously that AI tag helps us narrow our leads and to flip that first page, but then very early on we get disappointed, and when we get disappointed, we kind of close off the page and we're gone. And again, but most of my fellow panelists would be heavy travelers, and we read most of our BPs on the plane, right? So on our phone mostly. So don't turn us off by slapping too much AI tag on it. That's my advice. In terms of our last investment, I mean, my background and also our fund, we're very heavily focused on sort of life science and biotech. Our last deal was actually a organoid company, which is growing tissues and human tissues, as well as AI-driven in terms of artificial organs, right? So that's kind of where we were. The thesis was very simple, which is the testing cycle of drugs are way too long. Right? In order to develop a new drug, it's probably 8 to 10 years in the US or in Europe. The solution to that is really two, right? One is you go to somewhere that's cheaper and faster, which is India or China. And the other is to use tech to actually make this smarter and make this process faster. And that's already been a big thesis among sort of biotech investors for a very, very long time. So what we focused on is this level of smart testing. Are there companies or are there ventures out there that are smarter and propel this particular process in order to do this process more effective and more efficient? So we invested in this company. It's an organoid company. They effectively replace animal testing to growing like little balls of tissue in the lab, and you can test your drug on it. So imagine if we're hyping up the AI and saying, oh, AI drug discovery, because of all these different progress in AI and in models, you can synthesize and think about hundreds of different or millions of different drugs every minute. Well, you still need a ball of tissue to actually test the drug on it. And now that we don't use mice anymore in animal testing, that's why we invested in this particular company. So again, coming back to answering Oscar's question, I think what gets funded is something that has kind of an AI angle to it or a tech angle to it, but most importantly offers a very unique value proposition in the society, right? In a problem that we're trying to solve as a collective community of humans. Like we're trying to solve something. VCs are, contrary to most people, we're human. we're trying to solve something for the good of the society as well, using our powers. And if the ventures or the portfolio companies that we're investing in have that nexus to solve that problem, then that's something that's getting the money.
Good. Well, you made a great summary. Richard, what about you on your side?
Well, I really want to echo you gentlemen, because as we invest from very early stage all the way to very established companies, we do see the contrast. First of all, we also listen to a lot of hype and stories every day. However, on the other end, when we work with some established companies, when they talk about AI, that can be very, very serious. For example, we have a portfolio company, not recently invested, but right now they're filing for Hong Kong IPO. It's called XAG. They develop agricultural robots, like drones, vehicles, or IoT systems. Their products use a lot of AI to do auto navigation, agricultural tasking. But this company right now is like giving their end users an ROI and return on investment within 1 year. At the same time, the company itself is very profitable with a healthy cash flow. So when using AI and robotics can reach to that level, we believe that's something solid. We also see lots of examples happening in at least Chinese mainland. For example, we have some companies modifying ports and ships into alternative energy, renewable energy. At the same time, the next step would be install the AI on board, because maritime tasks is also very old school, relying on sophisticated technicians or captains. Also in vet health, also in pharmacy benefit management. So I think on our side, we're quite faithful to AI, although we probably need some, we hear bold stories every day. Yeah.
This is actually, I mean, you mentioned something that is interesting. You talk about profitability. And right now, one of the things that we're seeing globally, not just in Asia, not just in this particular sub-region, is that the graduation times for startups that are able to raise some initial seed capital through like convertibles or party rounds, the graduation rates to proper institutionally led rounds are dropping, and the time for that fundraising is becoming longer and longer. So what are the milestones and metrics? No? Like, and remember, Richard, you mentioned that you have actually two teams. One of them looking at the more early stage, another team looking at the growth stage. What are the key milestones or metrics that you think are necessary right now for the type of companies? And I know it's going to be different on every type of company, no? But especially comparing the way it was like a few years back when raising was easier.
That's a very good question, because I think that measurements always change. For example, what we see today from the seed stage, especially in the AI space, for example, GenSpark, it really starts with $200 million valuation from nothing, two people. They say they're really good. And it can also be some very talented team, but without some high-profile background. What they create is super valuable, but still, like, nobody really want to invest. So I think now in the very early stage, especially in this highly competitive spaces, it's becoming a consensus game. However, in the later stage, especially over the last 6 months, I think people's expectation changed a lot. I remember by the end of last year, lots of solid companies were valued at maybe 2-3 times of their sales. But now it's like 20 to 30 if we look at some of the robotic companies listed on Hong Kong Stock Exchange. So if we go back to these historical average, I think it's still valid to say that 10 to 20 times sales or like 50, 70 times of earnings would be a reasonable valuation for technology companies. So it really creates a lot of challenges for our work. But this is how we see.
I mean, we just had a Hong Kong FinTech Week here, and these valuations, based on what I've seen, they make a lot of sense for AI companies. But when you talk, for example, about fintech companies, they're looking at like 2-3x. That's a very different type of situation. And I know we're talking about AI, but there's also more beyond that. No? So what type of milestones in terms of governance, for example, in terms of team? No? You mentioned about you need to have high-profile talent. Not all the startups can have this type of talent. So anything, especially for Series B, no? Because I think that's I think you're the one that is the firm that is working on Series B. So anything specifically for that?
Oh, I will just very briefly. I think for Series B, it's about building an organization more than building a product. Because if we talk about a high potential AI company or anything that's disruptive to start with $200 million, that makes a lot of sense because you're aiming for 20 billion, 30 billion. But when you reach to stage B, we are looking at organized company building, more manageable timeline to the next stage, scaling up by business and capital terms. So this is, I think, one of the key differences that we do B investments versus A and pre-A. I think there's a gap for our practice there.
Okay. I'd like to jump to Kenny to talk about Series A's and the type of metrics and the type of requirements, because there's a lot of focus on that, multiples, revenue. You need to get like $1 million IRR, $5 million IRR. But what do you see in terms of metrics and milestones for Series A's?
Yeah, it's interesting you brought up revenue because that's not one of the metrics that we look at in order to evaluate product market fit. So we've got a framework that's developed from, I guess, our experience of evaluating companies in the consumer internet space, which this framework focuses on basically 4 metrics. So we look at conversion. So let's say if 100 people comes into your store, how many of them ended up buying something? right? Usage, does usage of the product service increase over time, right? And then retention, I guess there's a couple of dimensions where we look at retention, whether it's the number of people that have used it on day one, how many of them are still using it, let's say in 12, 24 months, right? And there's also a revenue angle to that as well. And lastly, it is basically a measurement of what we call marketing efficiency, or we call it the word of mouth, right? So how much money are you really having to spend to be able to get your customers in, right? So what these metrics are really driving at is these measures, these are proxy for two things. One is customer lifetime value, right? So usage and retention drives customer lifetime value. And the other two, conversion and word of mouth, is basically proxies for customer acquisition cost, right? So to us, if a product service that has product market fit has to have a good balance between these two. And this is, for us, a first filter that we would apply whenever we look at a company. Obviously, these are necessary but not sufficient conditions, but these are sort of our first filter to see whether a company has kind of achieved product market fit under this, I guess, our definition.
I'm going to get this recording and I'm going to share it with my investment team, because that's exactly what we tell them. Look, the revenue doesn't matter if there's no fundamentals behind. No? Like people they don't stop to check, no conversion, no retention. That's super critical. And I mean, revenue is a lagging indicator, but there needs to be a scalable infrastructure behind. So I really like the way you frame it and you explain it. Jake, you work with a lot of deep tech companies, and that's a different game. Like in most cases, we don't talk about revenue, and companies are able to raise like hundreds of millions of dollars without being able to see a penny. So, and at your stage, there's other metrics and other things that you look at companies. So, particularly for your companies that you back, and then they need to go out and raise institutional Series A larger rounds. What do funders need to focus on? What is exactly what makes the difference for them?
I think it comes back to the good traditional VC model of moats, right? Like, what is defensible? I mean, are you creating? Are you focused on a big enough problem that you're trying to solve? And that's why we were backing these companies in the first place. Then it moves on to, well, are you able to then create either a product or something that actually can make a difference? And how repeatable are the players who are doing that? I was, watching the previous panel. It's amazing that a lot of the professors or a lot of the PhDs that we talk to believe that they have a very unique product when actually, well, 5 other guys in other universities are doing the exact same thing, right? So you got to also be able to articulate why your particular company or why your particular product stands out, and why it's defensible, right? Like, patents are always good and all that, but we all know patents cost a lot of money to file. But at least, why your particular product is going to excel. And, coming back to my fellow panelists, VCs are not just about investing, right? Our jobs are also to guide and mentor and to actually help companies grow and scale. And we can only scale something that is unique, right? We can't really scale something that's a commodity. So that's really a big test for us. I mean, I guess, Oscar, we do look at revenue sometimes, right? Particularly in, say, for example, my medical equipment and device sectors, right? And that comes back to how are you, when we look at the company, do we judge that, is this a product that can be penetrated into the hospitals? Is it sellable? Is it something that you can do B2B selling into, and how quickly can you do that? It's no different than, let's say, assessing a SaaS or any other B2B type of companies. But obviously, we all know the medical equipment chain is a lot more complicated in that sense. But just having a good tech, having a good product, having your FDA approvals, etc., doesn't mean that you're going to have a very sellable product in the end. So we also have that extra layer of experts that come in and say, oh, we have an advisor who's actually a dean of medicine who would say, I would, it's a great product, it's cheaper than what we've got right now, but am I going to bother with assessing them for another 2 years and switching over from a very big name European provider that's been providing me with a CT scan for the last 10 years? Probably not, right? Yeah. So that's a test that we look at and a metrics that we look at as well.
Yep. When we have 5 minutes, so I want to have like one last question, but I want to share a reflection to connect with everything. I think everything that what they're sharing, it makes so much sense to a level that if you have something unique, you focus on the fundamentals, and you have a good organizational structure, you might actually end up in a situation where you scale without having to raise any capital. No? And this is something that we've seen multiple times. We've seen actually with some of our Hong Kong companies. One of our best performing companies in our portfolio is a company called BitMEX, originally born here. After our investment, they never raised any more follow-on capital on what they did. No? And the company, like last time the numbers were public, they were clocking over $500 million in profit annually. So, and they were able to do that because they had something at that moment unique, because they focus on the fundamentals of conversion, retention, monetization, and they build the infrastructure to be able to scale. And this is a side effect that we're seeing right now. We're seeing many of our portfolio companies that they're scaling, and they raise maybe a couple of million in a seed round. Next Series A is like a $37, $40 million Series A. Not always, but we see those cases, and we expect to see more of those because they focus on all these things. So this is not just for fundraising. This is to really build good companies. Fundraising is a tool to scale. But just quick, 1 minute. For those that need to fundraise, one piece of advice on how can they make your job easier, okay? If you are evaluating a company, how can they help you decide faster? Yes, no, let's talk in a year. So maybe Jake, let's start with you. Do you proceed from early?
I think, two things. One, be honest, right? I think a lot of entrepreneurs think that storytelling and having a salesperson is important, but when you're talking to VCs, we just want you to be honest and tell us who you are and what your team is about and what your product is about, right? And the second is help us help you, right? Which is we're playing with risk capital here when we're investing, so you got to make our jobs a little bit easier because you got to think from our perspective, how do we balance the risk, right? So that's the two pieces of advice I've got.
Thank you. Kenny, let's go to Ace.
I guess, for us, I guess be ready with the numbers. As you might have imagined, we followed a pretty quantitative approach. So, if founders are ready with the numbers and, have a good understanding of what they really mean to the business, that's always very helpful to us.
Thank you, Kenny. Richard?
So in addition to honesty and readiness, we would say still be brave to tell your dreams. We had these cases where entrepreneurs were so adaptive to this narrative to investors, so they couldn't tell what they really want to do, but write down some momentum trends. But we try to dig out some more story, and the company later became a great business. So just be brave.
I'm going to add one last piece of advice from my side. I work with a lot of companies on their fundraising. At the end of the day, the number one obstacle that I see killing most rounds of companies that have everything, they're brave, they're honest, they have their numbers in place, is that they need to build the trust. And trust needs time. You cannot build trust overnight. So when you don't know people, you need to build that trust. One way to build the trust is constant communication. So I had a number of companies that the investors felt, these funders, I chat with them like 2 months ago, they have not sent any update about what's happening in the company. Transparency and trust is critical. And this is something that's absolutely in your control. Okay? So with that, we're going to wrap up the panel. So please, big applause for the panelists. And thank you very much for staying here today.